Dividend investing is an easy way to earn passive income from owning stocks and ETFs. In this video, I'll explain exactly how dividends work and what you need to pay attention to before buying a dividend stock or ETF. At the end, I'll also give you two of my favorite dividend ETFs to get you started. So now let's get into it. Dividend investing is all about generating income from your investments. You buy a stock or ETF that pays you money on a monthly or quarterly basis. The dividends are payments made by a company to the people who own their stock, which are called shareholders. This payment is often in cash, but could also be in additional shares of that same stock. So, why do companies pay dividends? Well, when a company earns a profit, it has a few options of what to do with that money. It could reinvest it back into their business, for example, to buy new equipment or expand to new areas. But it could also buy back their own stocks, but that's a topic for a separate video. Or they can pay out some of that money to their shareholders in the form of dividends. Because when you buy a stock, you're effectively becoming a part owner of the company. So the idea is that when the company is making money, you are getting a share of that revenue. As I said before, the dividends are typically paid out on a quarterly or sometimes monthly basis, which provides a predictable source of income. And this is perfect for investors who are retired or looking for an extra source of income. Another benefit of dividend paying stocks is that they often have a lower level of volatility than non dividend paying stocks. This means that the price is steadier and less likely to change drastically in a short period of time. There are multiple reasons for this, and I can't address them all in this video, but the general idea is that companies typically start paying regular dividends once their company has reached a significant size and a level of stability. So, in comparison to a younger, faster growing company with promises that still have to come through and more uncertainty about the future, these older dividends paying companies are less likely to get heavily sold. Of course, this is not always the case, but on average, it is. Actually, when the overall market is performing badly, investors tend to move towards dividend paying stocks because that income also provides a level of stability for their portfolios. However, just like with any investments, there are also risks when it comes to dividend investing. The value or price of the stock that you bought could still go down, even if you're receiving dividend payments. Also, the dividend amount that the company pays out can change, and there is no guarantee that a company will continue to pay dividends in the future. The company is allowed to change their dividend policy depending on market conditions or how the company is performing. So, what do we need to pay attention to when we're looking for good dividend paying stocks? You need to look for companies with a history of consistently paying dividends and ideally paying increasingly more each year. You want to consider the growth potential and the sustainability of its dividend payments and the potential impact of changing economic conditions on its own business. I know this sounds complicated and a lot of work, and it kinda is. There are even more risks you need to be aware of, for example, the dividend value trap, which is when a very high dividend attracts investors to a potentially troubled or failing company. So, to avoid this whole problem and to save you a lot of time and energy to figure all this out and do the research yourself, there's an easier and, in my opinion, better way to approach dividend investing. And that's by investing in dividend ETFs. For those who don't know, an ETF or exchange traded fund is just a basket or group of assets, in this case, stocks. So instead of buying one stock from one company, you're buying 100 or even 1,000 different stocks at once without having to make all the effort of buying them individually. There are lots of different ETFs to invest in, and they all have their own structures in terms of percentages and what type of assets they hold. So, like I said, it could be that the 100 companies all have 1% share of that ETF, but it could also be that some of the companies have a higher percentage share than others based on certain criteria. ETFs make it easy for you to diversify, which means owning a wide spread of different stocks, which reduces the overall risk of your portfolio. This way, when one company fails or underperforms, it doesn't drag your whole portfolio with it. So, in my opinion, dividend ETFs are a much safer way to earn income than trying to pick individual stocks yourself. Like I said, there are a lot of different ETFs and they each have their own pros and cons. So let me give you 5 key factors you should pay attention to when investing in dividend ETFs. The first one is yield, which is the amount of dividends that you get paid per share per year expressed in a percentage of the share price. That sounds complicated, but it isn't. So let me give you an example. Let's say you have to pay $100 to buy an ETF, and it pays out $1 every quarter. You're getting $4 every year, meaning that this ETF has a 4% yield. So you want to look for ETFs with a high yield to maximize their potential income. The second factor you need to pay attention to is the expense ratio. This basically means the percentage you're paying in annual fees to the company that made the ETF. So obviously, you want to look for ETFs with a low expense ratio to minimize their costs and to maximize your returns. So sometimes you're going to have to weigh the benefit of a higher yield with a higher expense ratio versus a lower yield but also a lower expense ratio. The next factor is dividend history. This is the track record of the ETF in paying dividends consistently. This is pretty straightforward, and you want to look for ETFs that track stocks with a history of consistently paying dividends. Another factor is the dividend growth potential, meaning the potential for the ETF to increase its dividend payments over time. So you want to buy ETFs that track companies that have a history of increasing their dividends. For example, some companies have a history of increasing their dividends for over a decade. The fifth and last factor you need to pay attention to is diversification. As I explained before, this is the range of companies and sectors represented in the ETF. Unless you're looking to invest in a specific sector like technology or healthcare, you want to look for dividend ETFs that track a wide range of companies from different sectors and industries. This provides more diversification for your portfolio and therefore also reduces your risk. All of this can be pretty overwhelming at first, so it's important to do your own research and keep learning. However, I'll help you get started with two of my favorite dividend ETFs. I won't go into great detail, but this way at least you have something to go from. The first ETF is the Vanguard High Dividend Yield ETF, or VYM. And as the name suggests, this one focuses on high yielding dividend stocks. And as is standard with most of Vanguard's ETFs, VYM has a very low expense ratio of only 0.06%. So for every $1,000 you invest into this ETF, you're only paying 60 cents each year. The yield currently sits at just over 3%, and on top of that, the ETF price itself has also gone up on average over 9% each year since its inception in 2006. The ETF consists of 441 different stocks, so this gives you more than enough diversification. And the dividend has also increased for 12 consecutive years. VYM is a solid ETF with a low expense ratio and very decent returns. It's a good addition to any portfolio. The second ETF is the Schwab US Dividend ETF, or SCHD. And this one also has a low expense ratio of just 0.06%. And over the last 5 years, the average dividend yield has been 2.9%, while currently sitting at 3.6%. The ETF price itself has gone up on average over 12% each year since its inception in 2011. This ETF consists of 103 different holdings, which is quite a bit less than VYM, but still pretty decent. Also, the dividend has increased each year for the past decade. So overall, SCHD is a great ETF with a nice yield, strong growth, and amazing returns. So that was the complete beginner's guide to dividend investing. It's a great strategy for generating income from your investments, but it's important to carefully consider the risks and benefits before deciding to invest. Dividend ETFs can be an easier and safer solution for those who want to get started without having to do a lot of research into individual companies. Thanks for watching. I hope this helped you out. And if you enjoyed this video, please like and subscribe. That really helps me out. And if you're looking for more dividend ETFs, I'll also link a video right here on 5 of the best dividend ETFs out there. See you next time.